Welcome to the channel, everyone. If you're looking to take control of your financial future and learn the timeless principles of investing, you're in the right place. Today, we're diving into a classic that every serious investor should know, The Intelligent Investor by Benjamin Graham. This book is a goldmine of wisdom, offering insights that have stood the test of time and helped countless investors, including the legendary Warren Buffett, build their wealth. But here's the thing. Investing isn't just about numbers and charts. It's about mindset, strategy, and making smart decisions that can change your financial life forever. In this video, we'll break down the key ideas from the book, simplify them for you, and show you how you can apply these lessons to your own investing journey. So, whether you're a beginner or someone looking to fine-tune your strategy, get ready to dive into the world of intelligent investing. Let's get started. Chapter 1. Introduction to the Intelligent Investor. In this chapter, Benjamin Graham, the author, introduces the core concept of value investing. It's a fundamental idea in the world of finance, so let's break it down step by step. Benjamin Graham emphasizes that the stock market is not just about short-term profits or quick wins. Instead, he presents the idea of long-term, consistent, and cautious investing. Think of it as a marathon, not a sprint. The goal is to make steady profits over time, minimizing risks and avoiding the temptation of speculative trading. Graham introduces the concept of two types of investors, the defensive and the enterprising investor. Let's explore both. 1. Defensive investor. This is someone who wants to invest with minimal effort and time. They prefer a more passive approach and are focused on preserving their capital while earning a reasonable return. Defensive investors will focus on a balanced portfolio of bonds and stocks, choosing a mix that avoids riskier investments. 2. Enterprising investor. This investor is more active and willing to take on more risk in exchange for higher potential returns. They are hands-on, conducting research and analysis to find undervalued stocks or investments that others may overlook. While this strategy requires more time and effort, the potential for higher returns is there for the taking. Graham stresses that the key to success lies in emotional discipline. Many investors fail not because they lack knowledge, but because they let their emotions, like fear and greed, take over when making decisions. The intelligent investor understands that the stock market can be volatile, and they don't make decisions based on short-term market fluctuations. Moreover, he introduces the idea of margin of safety. This is a concept that helps protect your investments from potential losses. It means buying stocks or assets at a price lower than their intrinsic value, so there's a cushion if the market doesn't perform as expected. This reduces the risk of losing money. Finally, Graham outlines the importance of understanding the difference between investing and speculating. While investing involves buying assets based on their intrinsic value and long-term growth potential, speculation is more like gambling, relying on price fluctuations in the short term without regard for underlying value. The intelligent investor knows the difference and avoids speculative behavior. To wrap it up, the main takeaway from this chapter is the importance of a long-term mindset, emotional discipline, and the ability to distinguish between true investing and speculation. Whether you're a defensive or enterprising investor, the core principle remains the same. Investing is about patience, research, and minimizing risks while achieving steady growth over time. Chapter 2. The Investor and Inflation. In Chapter 2 of The Intelligent Investor, Benjamin Graham talks about a very important topic, inflation. Now, inflation might sound like a boring term, but trust me, it plays a huge role in your investment strategy. Let's dive into it. So what is inflation? In simple words, inflation is the rise in the general level of prices for goods and services over time. This means that as inflation increases, the purchasing power of your money decreases. For example, if inflation is at 3%, something that costs $100 today would cost $103 next year. Now, why should an investor care about inflation? Well, Graham explains that if you're just holding cash or low-interest investments, inflation can eat away at the value of your money. For instance, if inflation is 5% and your savings account only earns 2%, you're actually losing money in real terms. So, while your cash might be growing on paper, its value is shrinking in reality. Here's where things get interesting. Graham discusses how to protect your investments from inflation. The key idea here is that your investments need to outpace inflation. This means you need to focus on assets that can grow in value faster than inflation. Graham suggests investing in stocks, particularly those of strong companies that can raise their prices as inflation goes up. These companies are likely to perform better during inflationary periods because they can increase their earnings by adjusting prices without losing customers. Another option is bonds. But Graham warns that bonds can be tricky during inflation. You see, when inflation rises, interest rates tend to rise as well, and this can lower the value of existing bonds. But if you invest in bonds that have higher yields, you can still protect your purchasing power. Graham also mentions that during inflation, the value of real assets, like real estate or commodities, tends to rise. These are tangible assets, and their prices usually increase when inflation kicks in. So investing in these types of assets could help protect you from inflation's negative effects. But wait, there's more. Inflation isn't the same in every economy or time period. For example, high inflation can lead to economic instability, while low inflation might not have the same negative effects on investments. So, as an investor, you need to keep a close eye on the inflation trends and adjust your strategy accordingly. The big takeaway here is, don't ignore inflation. It can silently erode your wealth if you're not careful. By choosing the right investments, such as stocks and real assets, you can protect yourself and even benefit from inflation. To wrap up Chapter 2, Graham emphasizes the importance of understanding inflation's role in investing. It's all about making your money work harder than inflation is eating away at it. So, make sure your investment strategy is built to keep pace with or outpace inflation over the long term. Chapter 3, A Century of Stock Market History, the level of stock prices in the long run? Hey, welcome back. In Chapter 3 of The Intelligent Investor, Benjamin Graham takes us on a historical journey through the stock market. This chapter is all about understanding how stock prices have behaved over the long run and what we can learn from history to become smarter investors. So, let's break it down. Graham starts by reminding us that stock prices are volatile. This means they go up and down, sometimes in a way that seems unpredictable. But if we look at the long-term trend, things become clearer. Let's look at the big picture. Over a long period of time, the stock market has generally gone up. Yes, there have been crashes like the one in 1929, and many times the market has faced massive setbacks, but the overall trend is upward. This is because over time, businesses grow, economies improve, and innovation drives wealth creation. Graham takes us through 100 years of stock market data, from 1900 to 2000, showing how stock prices have evolved. He highlights key events like wars, depressions, and market bubbles, and how these events affected stock prices. Here's the thing, though. Despite all the ups and downs, the stock market has delivered positive returns in the long run. Now, one thing to keep in mind is that short-term fluctuations can be dramatic. You might see the stock market jump 10% one year and then fall 15% the next. But that's normal. The trick is to look at long-term trends and not panic during short-term drops. Successful investors aren't focused on what happens in the next month or year. They're thinking 10, 20, or even 50 years down the road. Graham also explains the idea of market cycles. The stock market goes through periods of growth and periods of decline, but these cycles are part of the natural rhythm of the economy. The market will always have ups and downs. Sometimes stocks get too expensive. We call this a bubble, and other times they get too cheap, a crash. But over the long run, things balance out. One important lesson here is that timing the market is nearly impossible. You can't predict when the market will go up or down in the short term, and trying to guess can lead to big mistakes. Instead, Graham advises investors to focus on buying good businesses at reasonable prices and holding them for the long term. This way, you'll benefit from the market's growth over time, rather than stressing over short-term fluctuations. Finally, Graham talks about the relationship between stock prices and earnings. When stock prices are high relative to earnings, also known as the price-to-earnings ratio or PE ratio, it's a sign that the market might be overvalued. On the flip side, When prices are low relative to earnings, it could indicate that stocks are undervalued, presenting a buying opportunity. To sum it up, the major takeaway from this chapter is that patience is key. The stock market has always recovered from its downturns and gone on to new heights. If you can withstand the short-term volatility and focus on long-term growth, you're more likely to come out ahead. Stock prices can be unpredictable in the short term, but history shows that over time, they tend to rise. So, remember, stay calm during market dips, focus on the long term, and invest in solid companies. If you can do that, you'll be on your way to becoming an intelligent investor. Chapter 4, General Portfolio Policy, the Defensive Investor. Hey everyone, in Chapter 4 of The Intelligent Investor, Benjamin Graham dives into a key topic, portfolio policy for the defensive investor. Now you might be wondering, what's a defensive investor? Don't worry, I've got you covered. Let's break it down. A defensive investor is someone who wants to make money in the stock market, but doesn't want to spend a ton of time researching, analyzing, or actively managing their investments. Basically, they want to keep things low effort and low risk. If that sounds like you, then this chapter is for you. Graham emphasizes that the defensive investor's primary goal is to preserve capital, that is, not losing money. They're not trying to become rich overnight, and they're not looking for big risky bets. Instead, they want to build a safe and steady portfolio that will provide long-term growth while avoiding major losses. So what should a defensive investor's portfolio look like? Graham gives some very practical advice. 1. Diversification is key. A defensive investor should never put all their money into just one type of investment. Instead, they should spread it across different asset classes, primarily stocks and bonds. This helps reduce risk because if one part of the market goes down, the other might still be doing well. Think of it as not putting all your eggs in one basket. 2. The 50-50 rule. Graham suggests that a defensive investor should have a balanced portfolio, where about 50% is invested in bonds and the other 50% in stocks. This way, they get some of the growth potential of stocks, while also having the safety of bonds. Bonds are less volatile and provide steady interest, making them a safer option for those who want to minimize risk. 3. How to choose stocks. When it comes to picking stocks, the defensive investor doesn't need to worry about finding the next hot stock or trying to time the market. Instead, they should focus on high-quality companies, those that have a long track record of stable earnings and a good reputation. These companies are less likely to go bankrupt or face big financial problems. 4. How to choose bonds. For bonds, Graham suggests sticking with high-grade bonds. These are bonds from trustworthy governments or companies with low chances of defaulting. These are safer investments compared to lower-quality, riskier bonds. So it's all about finding bonds that provide decent returns but come with minimal risk. 5. Regular rebalancing. As the stock market and bond market go up and down, the defensive investor should regularly rebalance their portfolio to maintain that 50-50 mix. If stocks do really well and rise, the investor might find that their portfolio is now 60% stocks and 40% bonds. Rebalancing means selling some of the stocks and buying more bonds to bring the ratio back to 50-50. Graham also advises that the defensive investor should avoid speculation. That means no risky bets on individual stocks or trying to predict short-term market movements. Instead, it's about making safe, well-thought-out investments and sticking to them. Long-term investing is the name of the game. Lastly, Graham points out that a defensive investor should always have an emergency fund, money that's easily accessible in case something unexpected happens. This helps protect against the temptation to sell investments during a market downturn because they need cash immediately. The big takeaway from this chapter? Don't chase after quick gains or get swept up in market hype. As a defensive investor, your focus should be on safety, stability, and steady returns. Build a balanced portfolio of quality stocks and bonds and hold on for the long haul. The goal is to grow your wealth gradually without taking on too much risk. So, to sum it up, diversify between stocks and bonds. Stick to safe, high-quality investments. Rebalance your portfolio regularly. Keep things simple and avoid speculation. Chapter 5, The Defensive Investor and Common Stock. In Chapter 5 of The Intelligent Investor, Benjamin Graham discusses the relationship between defensive investors and common stocks. Now, if you're a defensive investor, you might think stocks are too risky or complicated for you. But Graham explains that common stocks can actually be a good fit for defensive investors if they know how to choose wisely. Let's dive into it. First things first, what are common stocks? These are just regular stocks that you buy in companies, giving you a share of ownership. As a shareholder, you can benefit from the company's profits through things like dividends, cash payments to shareholders, and capital appreciation, the rise in the stock's price. Now, you might be thinking, aren't stocks super volatile and risky? Yes, they can be. But Graham explains that for defensive investors, the key is to focus on quality stocks and not chase after speculative, high-risk companies. In fact, Graham believes that common stocks can provide stable long-term returns when selected carefully. So, how should a defensive investor approach common stocks? 1. Look for stable, established companies. Defensive investors should aim for companies with a long history of solid earnings and stability. These companies tend to be less volatile and have a better chance of weathering economic downturns. Think of large, well-known companies like blue-chip stocks, companies with a strong track record, reliable profits, and a good reputation in the market. 2. Focus on companies with a good dividend history. Dividends are an important part of stock returns for defensive investors. Companies that consistently pay dividends, especially higher than average dividends, show they're financially stable and committed to sharing profits with shareholders. These dividend-paying companies can provide a steady income stream, which is great for the defensive investor who doesn't want to rely solely on stock price growth. Number 3, avoid speculative stocks. Graham strongly advises against investing in stocks that are considered hot or speculative. These are usually small, untested companies or stocks that are priced based on hype rather than real value. They can be very risky and may lead to significant losses. Instead, focus on stocks that are priced reasonably based on their intrinsic value, not based on short-term trends. 4. Don't try to time the market. One of the main ideas that Graham pushes throughout the book is that investors should not try to predict when the market will go up or down. The defensive investor should buy good stocks at reasonable prices and hold them for the long term, rather than trying to buy low and sell high based on market predictions. 5. The importance of diversification. As always, diversification is critical. Don't put all your money into just a few stocks, even if they seem solid. A defensive investor should spread their investments across different industries and sectors. This reduces the risk if one sector or company performs poorly. So, having a diversified portfolio of quality stocks helps balance things out and gives a better chance for consistent returns. 6. Investing in stocks versus bonds. While bonds are safer and more stable, stocks generally offer better long-term growth potential. The defensive investor can't ignore stocks entirely because they play an important role in building wealth over time. Remember, a 50-50 portfolio between stocks and bonds is ideal for balancing risk and return. Remember these important points. Defensive investors can invest in stocks, but the focus should be on stability and quality, not speculation. Look for established companies with a strong dividend history and a track record of steady earnings. Don't chase the latest market trends or try to time the market. Just buy quality stocks at reasonable prices and hold them for the long term. Diversification is crucial to reducing risk in your portfolio. Graham reminds us that patience is a virtue. Investing in common stocks isn't about quick gains or playing the market like a game. It's about finding companies that have proven their worth and holding onto them as they continue to grow over time. So, to sum it up, for defensive investors, common stocks are a great tool for long-term growth. As long as you choose wisely, stick to quality, and avoid the temptation to chase after speculative stocks. With a diversified, balanced portfolio and a focus on stability, you can sleep easy knowing you've got a solid strategy. Chapter 6, Portfolio Policy for the Enterprising Investor. The positive side? In Chapter 6 of The Intelligent Investor, Benjamin Graham shifts gears and talks about the enterprising investor, that's someone who's willing to put in more time and effort to actively manage their portfolio in order to get higher returns. If you're someone who enjoys doing research, making calculated decisions, and taking on a bit more risk for the chance of higher rewards, then this chapter is for you. Let's dive in. What is an enterprising investor? Before we dive into the details, let's quickly define who the enterprising investor is. Think of this person as someone who is actively involved in the stock market. Unlike the defensive investor who prefers a more passive approach, the enterprising investor is focused on seeking out opportunities to earn above-average returns by taking on a bit more risk. This doesn't mean reckless speculation. It means being smart, diligent, and aggressive in a calculated way. The key strategy for the enterprising investor. Graham starts by highlighting the positive side of the enterprising investor's approach. The opportunity to earn higher returns by actively managing the portfolio and making more informed, strategic choices. But here's the important part. Graham emphasizes that being an enterprising investor doesn't mean blindly jumping into any random stocks. Instead, it's about finding undervalued stocks or mispriced assets that have the potential to outperform the market over time. 1. Looking for undervalued stocks. Enterprising investors should focus on companies that are undervalued or selling for less than their intrinsic value. These stocks are often overlooked or misunderstood by the market, creating an opportunity for those who are willing to dig deep and understand their true potential. Graham suggests that these companies might be going through temporary problems that will eventually be resolved, leading to a rise in their stock price. 2. Special situations investing. One of the key opportunities for enterprising investors is looking for special situations. These are unique events like mergers, acquisitions, or restructurings that might lead to significant price movements. By paying attention to these events and analyzing the potential outcomes, an enterprising investor can make smart, calculated decisions that could lead to large gains. Number 3. The importance of research. While defensive investors rely on passive strategies like buying quality stocks and bonds, enterprising investors need to do their homework. Graham stresses the importance of research and analysis, knowing the financial health of companies, understanding the industry, and being aware of market trends. This research gives the enterprising investor the edge they need to make informed decisions and avoid risky bets. Number 4, managing risk. Even though the enterprising investor takes on more risk for the potential of higher rewards, risk management is still key. Graham advises that enterprising investors should diversify their investments and not put all their money into one stock or one type of asset. A well-balanced portfolio helps spread out the risk and minimizes potential losses. It's about making smart bets, not gambling. Number 5, using other people's money wisely. One of the strategies discussed in the chapter is the use of leverage, that is, borrowing money to invest. This can amplify returns, but it also increases the risk. So, it's not something to do lightly. Enterprising investors should use leverage carefully and understand that it can be a double-edged sword. While it can lead to higher gains, it can also lead to greater losses if things don't go as planned. Number 6, the role of bonds in an enterprising portfolio. Graham also mentions that while enterprising investors are more focused on stocks, bonds can still play an important role in their portfolios. Bonds can provide stability, steady income, and help reduce overall portfolio risk. However, unlike the defensive investor, the enterprising investor is likely to have a higher percentage of stocks and fewer bonds in their portfolio. The bottom line for enterprising investors. The big takeaway here is that enterprising investors are actively looking for opportunities that can deliver better than average returns. They're not sitting back and waiting for the market to come to them. They're researching, analyzing, and taking a more hands-on approach. This could mean investing in undervalued companies, taking advantage of special situations, or even using leverage to amplify returns. However, Graham cautions that this approach requires a lot of knowledge, skill, and discipline. Enterprising investors must always be aware of the risks they are taking and manage them carefully. It's a more active strategy, but if done correctly, it can lead to higher returns than the more passive, defensive approach. To sum it up, enterprising investors look for undervalued stocks and special situations. They need to put in time and effort to research and make informed decisions. Risk management is crucial, even for active investors. Leverage can amplify returns, but should be used cautiously. In short, this chapter teaches us that while the defensive investor takes the safe route, the enterprising investor can achieve higher returns by putting in the work, being strategic, and managing risk carefully. Chapter 7, The Enterprising Investor and Common Stocks. In Chapter 7 of The Intelligent Investor, Benjamin Graham continues exploring the strategies of the enterprising investor, and this time, we're talking about common stocks, the kind of stocks you might actively seek out for higher returns. If you're aiming for a more hands-on approach and want to invest in stocks with a bit more potential, then this chapter is for you. Let's break it down. What are common stocks for the enterprising investor? First off, Graham dives into how the enterprising investor should think about common stocks. Remember, the enterprising investor is someone who is ready to spend more time, effort, and research to look for opportunities that can give them higher than average returns. So, while defensive investors are usually focused on stability, the enterprising investor is looking to get the best bang for their buck, even if it involves taking on more risk. But here's the catch. Even though the enterprising investor wants to get higher returns, common stocks, the regular stocks you find on the market, come with risks, and it's important to approach them wisely. It's not about betting on stocks just because they're popular. It's about finding stocks that are undervalued or have strong growth potential over the long term. Key strategies for enterprising investors with common stocks. Graham lays out several important strategies for the enterprising investor when it comes to investing in common stocks. Here's a breakdown. 1. Look for undervalued stocks. The enterprising investor should focus on undervalued stocks. These are stocks that are selling for less than their intrinsic value. These stocks might be underappreciated by the market, and the investor can profit as their true value is realized. Graham advises looking for companies that are financially strong, but going through a temporary setback or mispricing. If you can spot these opportunities, you can buy low and eventually sell high once the stock's value catches up. Number 2, know the intrinsic value. When searching for undervalued stocks, the enterprising investor needs to have a clear understanding of the company's intrinsic value. This means looking beyond just the current stock price and focusing on the company's earnings, assets, and potential for future growth. You want to understand what the company is really worth and make sure the stock is trading for less than that value. 3. Look for quality companies with strong earnings. Not all stocks are created equal. The enterprising investor should look for companies with strong earnings records and the potential for future growth. These companies are usually established, have solid management, and are positioned well in their industries. Stocks from these kinds of companies can provide consistent returns over time. 4. Special situations. Graham highlights that enterprising investors can also take advantage of special situations, events like mergers, acquisitions, or even a company's financial restructuring. These situations often lead to sharp price changes, and with the right knowledge, enterprising investors can profit from these events. It's about spotting opportunities where others might not see them. 5. Investing in smaller companies. While big companies are a safe bet, Graham also suggests that enterprising investors look at smaller companies or growth stocks. These stocks often carry more risk, but they can deliver huge returns if the company grows successfully. Of course, investing in small-cap stocks means you need to carefully research the company's potential and ensure that its growth prospects are real. 6. Don't follow the crowd. A common mistake many investors make is following the crowd and buying stocks based on popular trends or market hype. Graham warns the enterprising investor to avoid speculative investments and not chase after stocks that are hot right now. Instead, stick to your strategy of finding undervalued companies or special situations, even if they're not the most popular pick. 7. Diversify your stock portfolio. Although the enterprising investor is actively seeking out opportunities for higher returns, diversification is still important. Don't put all your money into one stock or one sector. Spread your investments across different industries and types of stocks to reduce risk. Diversification helps protect your portfolio from the downside of any one particular investment. The bottom line for enterprising investors and common stocks. To wrap things up, Graham's big message is that enterprising investors can do really well with common stocks, but it requires a strategic and informed approach. The focus should always be on finding undervalued stocks with strong earnings potential, avoiding speculative bets, and taking advantage of special situations. But remember, the enterprising investor needs to do their research, understand the company's true value, and diversify to manage risks. The enterprising investor has more flexibility to take risks for higher rewards, but it's important to do so wisely. If you can find those hidden gems in the stock market, you'll be able to outperform the broader market in the long run. Remember these important points. Undervalued stocks offer a chance to buy below market value and sell for a profit. Focus on the intrinsic value of the stock, what the company is truly worth. Look for strong earnings and future growth potential in companies. Special situations, like mergers or restructurings, can create opportunities. Diversify your stock portfolio to manage risk effectively. Chapter 8. Investing in investment funds. In Chapter 8 of The Intelligent Investor, Benjamin Graham takes a deep dive into investment funds. That is, the type of funds that pool money from different investors to buy a variety of assets like stocks, bonds, and other securities. If you're thinking about investing your money but want to spread out the risk, investment funds could be a great option. Let's break this down in simple terms so you can get a solid understanding. What are investment funds? Before we get into the details, let's define what investment funds are. An investment fund is essentially a pool of money from multiple investors that is managed by professionals. The fund manager uses this money to buy and sell different assets, like stocks, bonds, or real estate, based on the fund's goals and strategy. It's a way for individual investors to gain exposure to a diversified portfolio without having to pick and manage all the investments themselves. Types of investment funds. There are different types of investment funds, and Graham goes through them in the chapter. Let's look at the most common ones. 1. Mutual funds. These are the most traditional type of investment funds. Mutual funds pool money from investors to invest in a wide range of securities, like stocks, bonds, or even both. The fund is managed by a professional portfolio manager, and the goal is to provide a diversified investment for individuals who don't have the time or expertise to do it on their own. 2. Exchange-traded funds, ETFs. Similar to mutual funds, ETFs pool money from investors, but they are traded on the stock exchange just like individual stocks. ETFs generally track a specific index, like the S&P 500, so they allow investors to own a small piece of a large number of companies, giving them instant diversification. Number 3. Closed-end funds. These funds are a bit different from mutual funds and ETFs. A closed-end fund has a fixed number of shares that are traded on the stock exchange. The price of the fund's shares depends on supply and demand, and it can trade at a premium or discount to its net asset value, NAV, which is the value of the assets it holds. Before, hedge funds. These are more exclusive investment vehicles that often require a high minimum investment. Hedge funds typically invest in more complex strategies, such as short selling, derivatives, or other alternative investments. They often aim to deliver high returns, but they come with higher risks and higher fees. Number 5. Index funds. These are a type of mutual fund or ETF that tracks a specific market index, like the S&P 500 or the Dow Jones. Index funds aim to replicate the performance of the index they track, rather than trying to beat it. They are low cost, passively managed, and provide broad market exposure. Pros of investing in funds. Now, you might be wondering, why should I invest in funds instead of picking individual stocks or bonds? Well, here are some key advantages of investing in funds. 1. Diversification. One of the biggest advantages of investment funds is that they offer instant diversification. Instead of putting all your money into one stock or bond, you can invest in a fund that holds a wide variety of securities. This helps reduce your risk because the performance of the fund isn't dependent on one single asset. 2. Professional management. Many funds are managed by professional managers who have the expertise to make informed investment decisions. You don't have to worry about researching every company or asset. The fund manager does it for you. 3. Accessibility. With a relatively small amount of money, you can invest in a wide range of assets. Funds allow you to access markets that might otherwise be difficult to reach, such as international stocks or bonds. 4. Lower risk. Since funds are diversified across multiple assets, they are generally less risky than investing in individual stocks or bonds. If one asset performs poorly, the others in the fund may help balance things out. Number 5. Liquidity. Most funds, like mutual funds and ETFs, are fairly liquid, meaning you can buy and sell them relatively easily. If you need to access your money, you can usually do so without much hassle. Risks and considerations. While investment funds have a lot of benefits, they aren't without their risks and considerations. Here are some things to keep in mind. 1. Management fees. One thing to watch out for is management fees. Many funds charge a fee for managing your investments. These fees can eat into your returns, especially over the long term. Always check what the fees are before investing. 2. No guaranteed returns. Just because you invest in a fund doesn't mean you're guaranteed to make money. Like any investment, funds can go up or down in value based on market conditions. The key is choosing a fund that aligns with your investment goals and risk tolerance. 3. Performance can vary. Not all funds will outperform the market. Some funds will do better than others, and even professional fund managers can make mistakes. It's important to research the fund's track record and strategy before investing. 4. Over-diversification. While diversification is good, some funds might become over-diversified, meaning they hold too many assets that don't necessarily add value. This can dilute potential returns. Remember these important points. Investment funds are a great way to diversify your portfolio and gain exposure to a wide range of assets. There are several types of funds, including mutual funds, ETFs, closed-end funds, hedge funds, and index funds. Funds come with professional management, making them a good choice for those who don't have the time or expertise to manage their own investments. The main pros of funds are diversification, professional management, accessibility, lower risk, and liquidity. However, watch out for fees, lack of guaranteed returns, and over-diversification. The bottom line: if you're looking for a hands-off way to invest and grow your wealth, investment funds are a great option. They allow you to access diversified portfolios without needing to pick individual stocks or bonds yourself. But remember to pay attention to the fees, fund performance, and ensure that the fund matches your investment goals and risk tolerance. The Investor and Market Fluctuations, Chapter 9. Welcome back. In Chapter 9 of The Intelligent Investor, Benjamin Graham discusses a key topic that every investor faces: market fluctuations. The stock market is constantly moving up and down, and understanding how to navigate these fluctuations can make a huge difference in your investing journey. Let's break it down and see how you can stay calm, collected, and make better decisions in the face of these unpredictable movements. What are market fluctuations? To start, let's define what market fluctuations are. Simply put, they're the ups and downs in stock prices caused by various factors: economic conditions, news events, changes in interest rates, and even investor emotions. The stock market can experience wild swings in a short period, and it's easy to get caught up in the hype, fear, or excitement. But Graham's point is that investors shouldn't focus too much on these short-term movements. Instead, they should focus on their long-term goals. The Mr. Market analogy. Graham introduces one of his most famous concepts in this chapter: Mr. Market. Think of Mr. Market as a very emotional business partner who offers to buy your stocks every day and sell them back to you. Some days, Mr. Market is optimistic and offers a high price for your stocks, while on other days, he's feeling pessimistic and offers a low price. The key thing Graham points out is that you don't have to accept Mr. Market's offer. Instead of being swayed by his mood swings, you can make decisions based on the true value of the stocks, not just the price Mr. Market offers on any given day. This means not getting caught up in the fear or greed that drives market fluctuations. Emotional reactions to market movements. Graham explains that the biggest mistake investors make is letting emotion drive their decisions. When the market is rising, investors can get overly excited and start buying stocks impulsively. On the flip side, when the market is falling, fear takes over, and they might sell stocks in a panic. This cycle of buying high and selling low is exactly what you want to avoid. The key message here is to keep a long-term perspective. If you're investing in quality stocks or bonds, short-term market fluctuations shouldn't have a significant impact on your overall strategy. It's about staying calm and focused on your goals rather than reacting to every market movement. Risk and volatility. Another important point Graham makes is about understanding risk. The fluctuations in the market are a natural part of investing, and volatility, the degree of price movement, is something every investor must learn to live with. The market doesn't go up in a straight line. It has ups and downs. Graham argues that the more volatile an investment, the higher the potential risk, but also the potential reward. However, Graham suggests that for most investors, especially those with a defensive approach, it's important to manage risk carefully and not be tempted to take on too much volatility in search of quick returns. The goal should be steady, long-term growth rather than trying to time the market. The role of the defensive investor. For the defensive investor who wants to avoid unnecessary risk and volatility, market fluctuations can be particularly challenging. However, Graham suggests that the defensive investor should avoid reacting to market fluctuations. Instead, focus on creating a well-diversified portfolio with a mix of stocks and bonds so you're not overly affected by market swings. One strategy that Graham emphasizes is buying quality stocks when they are undervalued and not selling them when the market is down. It's about having a strategy that allows you to stay the course, regardless of whether the market is going up or down. The enterprising investor's perspective. On the other hand, the enterprising investor who is willing to take more risks for potentially higher rewards might look at market fluctuations as opportunities to buy undervalued stocks. The key is to approach these opportunities with discipline and research rather than emotional reactions. If the market dips and quality stocks become cheaper, the enterprising investor might take advantage of this by purchasing more shares. But again, this requires careful analysis and a clear strategy. The bottom line, don't let market fluctuations distract you. So, what's the main takeaway from this chapter? The key is to not let market fluctuations control your actions. Whether the market is going up or down, stick to your investment strategy. Don't be tempted to chase short-term gains or panic during market downturns. Instead, focus on the long-term value of your investments and stay calm and rational. Graham stresses that market fluctuations are normal and should be expected. The investor who can stay calm during these fluctuations, make decisions based on reason rather than emotion, and focus on long-term goals will be the one who comes out ahead in the end. Key points to remember. Market fluctuations are normal, and they happen because of various factors like news, economy, and emotions. The Mr. Market analogy shows that investors don't have to react to the market's ups and downs. Instead, focus on the true value of investments. Emotional reactions, such as fear and greed, can cause investors to make poor decisions. Avoid buying high and selling low. Understand volatility and risk, and be prepared to handle market ups and downs. Defensive investors should stick to a diversified and long-term strategy and avoid reacting to market swings. Enterprising investors can use market fluctuations as opportunities, but only if they've done their research and have a solid strategy. By focusing on long-term goals and sticking to your strategy, you'll be better equipped to handle whatever the market throws at you. It's all about staying calm, rational, and disciplined when the market goes wild. Keep your eyes on the prize, and don't get distracted by the noise. The Investor and His Advisors, Chapter 10. Benjamin Graham discusses an essential aspect of investing, the relationship between investors and their advisors. Many investors look for professional advice, but Graham warns that choosing the right advisor and understanding their role is critical. Let's dive into the key points from this chapter to help you make informed decisions about when and how to rely on an advisor. The role of an investment advisor. First, let's talk about what an investment advisor does. Essentially, an advisor is someone who offers guidance and recommendations on how to invest your money. They might suggest specific stocks, bonds, or other investment vehicles based on your financial goals and risk tolerance. Some advisors may even manage your portfolio for you. Graham emphasizes that the role of an advisor is to assist, not to make decisions for you. As an investor, you must remain actively involved and make your own choices. The advisor's job is to provide valuable insights, but you, the investor, should ultimately be in control of your investments. Types of advisors. There are different types of advisors out there, and it's important to know what they offer and how they get paid. Let's look at a few types. 1. Full-service advisors. These advisors provide comprehensive services, including investment management, financial planning, and tax advice. They charge a fee for their services, which can be a flat rate or a percentage of the assets they manage. 2. Discount brokers and robo-advisors. These are lower-cost options where you might receive limited or no personalized advice. Discount brokers offer the ability to buy and sell investments at a lower cost, while robo-advisors use algorithms to manage your portfolio based on your financial goals. These options can be a good fit if you don't need hands-on advice and want to save on fees. 3. Independent financial planners. These professionals often focus on more than just investments. They may provide holistic advice on retirement planning, estate planning, and tax strategies. They generally charge hourly fees or flat rates rather than commissions on investments. Choosing the right advisor. Graham stresses the importance of choosing an advisor who aligns with your investment philosophy and goals. The best advisor isn't necessarily the one with the most impressive credentials or flashy marketing. Instead, you should focus on their track record and their ability to provide consistent, objective advice. Here are some tips on selecting the right advisor. Know the fees. Make sure you understand how your advisor is compensated. Are they charging a percentage of your assets, or are they getting paid through commissions? Be aware of any hidden fees or incentives that might lead them to recommend investments that aren't in your best interest. Check qualifications. While a good advisor doesn't need to have a fancy title or extensive background, they should have a solid understanding of financial markets and investing principles. Certifications like CFP, Certified Financial Planner, or CFA, Chartered Financial Analyst, are good signs, but experience and trust are equally important. Understand their philosophy. Make sure their investment philosophy aligns with yours. If you are a defensive investor, you want an advisor who focuses on preserving capital and is risk-averse. If you are more enterprising, you might prefer an advisor who can help you look for more aggressive opportunities. The importance of independence. Graham talks about the importance of independence when it comes to investment advice. Some advisors may have a conflict of interest, like earning commissions on certain products or being tied to specific investment firms. Independent advisors are generally better suited to give objective advice without being influenced by outside pressures. However, Graham also warns that some independent advisors might overcharge for their services or give poor advice. So always do your homework and make sure your advisor is working in your best interest. How much control should you give? A key point Graham makes is that you should never completely hand over control of your investments to an advisor. You should stay actively involved in making decisions and ensure that your portfolio is aligned with your goals. If you're unsure about an investment recommendation, ask questions and do your own research. An advisor should be able to explain their reasoning clearly, and you should feel comfortable questioning them. While an advisor can be helpful in making investment decisions, Graham argues that you should always retain the final say in how your money is managed. This means regularly reviewing your portfolio and staying informed about the choices your advisor is making on your behalf. The investor's responsibility. At the end of the day, Graham stresses that investing is your responsibility. Advisors can help, but you need to take ownership of your financial future. It's important to understand the fundamentals of investing, even if you're working with an advisor. This way, you'll be in a better position to make smart, informed decisions and recognize if an advisor isn't acting in your best interest. Graham also points out that advisors can't always predict or control market fluctuations, so don't expect them to provide foolproof strategies. A good advisor will help you navigate uncertainties and develop a strategy that works for your individual needs. Remember these important points. Investment advisors provide advice and guidance, but you should always stay in control of your decisions. There are different types of advisors, from full-service advisors to robo-advisors and independent planners. Understand the fees and services each one offers. Choose an advisor whose investment philosophy aligns with your own goals and values. Be cautious of conflicts of interest and ensure your advisor is independent and objective. You should always retain ownership of your investments and stay involved in decision-making, even if you have an advisor. Your advisor should help you navigate uncertainty, but you need to understand the basics of investing to make informed choices. In the end, having an advisor can be beneficial, but you should never abdicate all control of your investments. Whether you're working with a professional or managing your own investments, the key to success is staying informed, disciplined, and focused on your long-term goals. The right advisor will guide you, but your success depends on making smart, well-informed decisions along the way. Security Analysis for the Lay Investor, General Approach, Chapter 11. In Chapter 11 of The Intelligent Investor, Benjamin Graham dives into the world of security analysis, which might sound complex, but don't worry, we'll break it down into simpler terms. For the lay investor, that's you and me, Graham provides a general approach to analyzing investments, specifically stocks and bonds, so you can make better informed decisions. Let's get into it. What is security analysis? First things first, security analysis is the process of evaluating an investment to determine its intrinsic value. That is, what it's truly worth based on fundamentals like financial health, growth potential, and market conditions. Security analysis helps you decide if an investment is undervalued, a good deal, or overvalued, too expensive. Graham believes that every investor, even a lay investor, someone without a financial background, can analyze securities to make smarter investment choices. You don't need to be an expert to start understanding the basics of security analysis. Let's see how you can do it. The two key areas of analysis: qualitative and quantitative. When you analyze a security, you're looking at both qualitative, the quality of the company, and quantitative, the numbers factors. These are the two main components that will guide your decision-making. 1. Qualitative factors. The qualitative side is all about understanding the business itself. You want to ask questions like, is the business model solid and sustainable? Does the company provide goods or services people will continue to buy in the future? How competitively positioned is the company in its industry? Does it have an edge over its competitors? What's the management like? Are they experienced, honest, and focused on long-term growth? Does the company have a clear strategy for the future? In other words, you're trying to get a sense of the company's future potential, its market position, and whether it's likely to continue growing or if it's facing risks that could hurt its prospects. 2. Quantitative factors. Now, the quantitative side focuses on the numbers, the financial health of the company. Here's where you'll need to look at things like earnings growth. Is the company consistently growing its earnings, profit year after year? Debt levels. How much debt does the company have? Is it manageable, or is the company over-leveraged? Dividend history. Has the company been paying consistent dividends? This shows how well the company is managing its profits and rewarding shareholders. Price to earnings ratio, PE ratio. This tells you how expensive the stock is compared to its earnings. A lower PE might suggest the stock is undervalued, while a high PE could indicate overvaluation. By looking at these numbers, you'll get a clearer picture of whether the company is financially stable and profitable. The margin of safety. One of the most important concepts in Graham's approach to security analysis is the margin of safety. This means that when you buy a stock, you want to buy it for less than its intrinsic value. The lower the price relative to the intrinsic value, the safer the investment. Think of it like buying a car. If you know the car is worth $10,000, but you manage to buy it for $7,000, you've created a margin of safety. Even if something goes wrong and the car's value drops, you're still not losing as much. This principle helps protect investors from market fluctuations and the inherent risks of investing. The role of diversification. Graham also highlights the importance of diversification in security analysis. While analyzing individual securities, you should never put all your money into one stock or one type of investment. By diversifying your investments, you spread out the risk and reduce the chance that a single bad investment will hurt your overall portfolio. Diversification is key to managing risk and improving the long-term stability of your investments. For example, if one stock in your portfolio loses value, the other stocks or bonds might still perform well, balancing out the overall risk. The investor's attitude toward market movements. Graham emphasizes that lay investors should not be swayed by short-term market movements. When the market fluctuates, stock prices may go up or down, but this doesn't always reflect the company's true value. As a long-term investor, you should focus on the fundamentals and not panic when prices fluctuate. The goal is to buy undervalued securities with a good margin of safety, hold them, and let the market eventually recognize their true worth over time. The 3 levels of security analysis. Graham categorizes security analysis into 3 levels. 1. Investor level analysis. This is the basic analysis that anyone can do, looking at the company's fundamentals such as earnings, debt, and growth potential. 2. Speculative level analysis. This is more advanced and involves trying to predict short-term price movements based on market trends or speculation. 3. Professional level analysis. This is what institutional investors or analysts do. Deep, detailed analysis, often involving access to insider information and more sophisticated techniques. As a lay investor, you'll mostly focus on investor-level analysis, which focuses on evaluating the company's fundamentals rather than trying to predict short-term price changes. Key takeaways. Security analysis involves understanding both qualitative factors, the business model, management, market position, and quantitative factors, financial health, earnings growth, debt levels. The margin of safety is crucial. Buy stocks for less than their intrinsic value to protect yourself from risk. Diversification is key to spreading out risk across your portfolio. Don't get caught up in short-term market fluctuations. Stay focused on long-term fundamentals. As a lay investor, focus on basic analysis. You don't need to be a professional to make smart investment choices. In this chapter, Graham equips you with the tools to analyze securities, even if you're not a financial expert. By looking at the company's fundamentals, maintaining a margin of safety, and staying diversified, you can make sound investment decisions that will help you build long-term wealth. Remember, investing isn't about timing the market. It's about finding value and sticking to a disciplined approach. Things to consider about the market. Chapter 12. Hey, welcome back. In Chapter 12 of The Intelligent Investor, Benjamin Graham takes a closer look at the market itself. Specifically, how investors should think about it, and the common pitfalls to avoid when navigating the stock market. This chapter is all about understanding the market's behavior and making better decisions, no matter how the market is performing. Let's dive in. The market as a wealth-making machine. Graham starts by explaining that the market is not just a random place where stocks go up and down. Instead, he views the market as a wealth-making machine, but one that works only if you use it correctly. Many investors tend to treat the market as a gambling platform, trying to time their buys and sells based on short-term fluctuations. However, the true power of the market lies in making informed, long-term decisions. Market prices, driven by emotions. Graham stresses a major point here. Market prices are often driven by emotions, not by logic or fundamentals. Investors are influenced by fear and greed, causing the market to swing between extremes. During a bull market, rising market, investors get overly excited, pushing prices too high. In contrast, during a bear market, falling market, fear takes over and prices can drop far below their intrinsic value. This emotional behavior creates opportunities for disciplined, long-term investors who focus on the fundamentals of a company rather than the current market mood. The market is not always rational. Graham explains that the market is not always a rational place. In fact, stock prices can sometimes be irrationally high or irrationally low, based on investor sentiment rather than a company's actual performance. This is where value investing comes into play. Investors can find undervalued stocks when the market overreacts, either in euphoria or panic. It's important to remember that just because a stock price is rising quickly, it doesn't mean the company's fundamentals have improved. Similarly, just because a stock price is falling doesn't mean the company is failing. The key is to understand the true value of a stock, regardless of what the market is doing in the short term. Mr. Market, the emotional investor. Graham introduces the concept of Mr. Market, a fictional character who represents the stock market itself. Mr. Market is a moody, emotional investor who offers to buy or sell stocks to you every day. Sometimes he's overly optimistic and willing to pay you a high price. Other times, he's depressed and offers a low price. But here's the catch. You don't have to agree with him. You can choose when to buy and when to sell based on your own judgment, not Mr. Market's moods. The moral of the Mr. Market analogy is clear. Don't follow the crowd, especially when emotions are running high. Instead, focus on value and invest based on your own research, not on what the market is doing in the short term. The importance of long-term thinking. Graham emphasizes that successful investing is about thinking long-term. The market might be unpredictable in the short term, but over the long run, it tends to reward investors who are patient and make smart decisions based on fundamentals. This is where the concept of the intelligent investor comes into play. You don't need to react to every market move. Instead, focus on building wealth steadily over time through consistent, well-thought-out investments. Don't try to time the market. Another key point Graham makes is about market timing, trying to buy and sell stocks based on predictions about future market movements. He advises against this, saying it's nearly impossible to consistently predict market movements accurately. The best strategy is to focus on buying good investments when they are undervalued and holding them for the long term. Don't let the market control you. Many investors get caught up in the excitement of market fluctuations, but Graham advises to ignore the noise. Whether the market is going up or down, don't let your emotions take over. Stick to your strategy, focus on your investment goals, and don't panic when things get tough. The market will fluctuate. It's part of the game. The key is to stay calm, avoid making impulsive decisions, and keep your eyes on your long-term objectives. Remember these important points. Market prices are often influenced by emotions, not fundamentals. Fear and greed can cause irrational price movements. Use the market's emotional swings to your advantage by investing based on value, not market sentiment. Mr. Market represents the emotional nature of the market. You don't have to follow his moods. Long-term thinking is crucial. Successful investing is about making decisions based on the fundamentals, not on short-term fluctuations. Market timing is nearly impossible. Focus on buying undervalued stocks and holding them for the long term. Don't panic during market fluctuations. Stick to your plan and remain disciplined. In this chapter, Graham emphasizes that the market isn't always rational, and as an investor, it's your job to avoid getting swept up in its emotional waves. Instead, focus on long-term strategies, make decisions based on the intrinsic value of companies, and avoid following the herd mentality. The intelligent investor doesn't react to the market. They take a calm, disciplined approach and allow their investments to grow steadily over time. The Investor in Stock Market Speculation, Chapter 13. Hey there. In Chapter 13 of The Intelligent Investor, Benjamin Graham dives into a very important topic, stock market speculation. Now, what does that mean? Well, stock market speculation is when investors buy stocks not because they believe in the company's long-term potential, but because they think the price will rise quickly in the short term. In this chapter, Graham talks about the difference between investing and speculating and why it's crucial for you to understand the distinction. Let's break it down. Investment versus speculation. First off, let's clarify the difference between investing and speculating. Graham says that investing is about buying stocks based on the intrinsic value of the company, their long-term potential and fundamentals. You're in it for the long haul, and you want to see the company grow over time. Speculation, on the other hand, is when you buy stocks based on short-term price movements. You're betting that the stock's price will go up, but not necessarily because the company's fundamentals are strong. It's more like gambling on the market's fluctuations. Graham stresses that true investors buy based on a company's value and growth potential, while speculators are more interested in the price and timing of the market. As an investor, Graham suggests avoiding speculation because it's riskier and doesn't align with the goal of building long-term wealth. Why speculation is dangerous. So, why is speculation risky? Let's break it down. 1. Unpredictable market movements. The market is volatile, and trying to predict short-term price movements is almost impossible. The stock market doesn't always follow logic, and it can swing based on emotions, news, or rumors. Speculators try to profit off these unpredictable swings, but this leaves them vulnerable to big losses when things don't go as planned. 2. Lack of fundamentals. Speculators often ignore a company's financial health, management, and long-term potential. Instead, they focus on timing, buying when they think the price is low and selling when they think it's high. But this can lead to irrational decisions and buying overpriced stocks that could crash later. 3. Emotional decisions. Speculation often triggers emotional trading. You might feel excited when prices are rising and get fearful when they're falling. This emotional roller coaster can cloud your judgment and lead to impulsive decisions. Speculation and the influence of the market. Graham also talks about how the market can make speculation easier. When stocks are rising, speculators feel confident that prices will keep going up. They may get overly optimistic and start buying stocks just because everyone else is. This creates a bubble. Prices get inflated, and when reality sets in, the bubble bursts, causing big losses. Graham warns that speculation works like a short-term game. While it might feel exciting to try to profit quickly, the odds of success aren't in your favor. In fact, most speculators end up losing money because they rely on luck rather than a sound investment strategy. The importance of a margin of safety. In contrast to speculating, Graham emphasizes the importance of a margin of safety for investors. This means buying stocks for less than their intrinsic value to protect yourself from losses. If you buy stocks at a bargain price, below their true value, even if the market drops temporarily, you have some cushion to absorb the losses. This is the key difference between investing and speculating. As an investor, you want to focus on companies that are undervalued, with solid fundamentals. That way, even when the market fluctuates, your investments are more likely to recover and grow over time. How to avoid speculation. Graham suggests several ways to avoid falling into the trap of speculation. 1. Stick to the fundamentals. Focus on investing in companies with strong financial health, solid growth prospects, and a good management team. Don't buy based on hype or short-term price movements. 2. Think long-term. Don't get caught up in the excitement of quick profits. Instead, focus on the long-term growth potential of your investments. Look at stocks as a way to own a piece of a company, not just a trading instrument. 3. Stay disciplined. Stay calm during market fluctuations. The market will go up and down, but don't make impulsive decisions based on short-term price changes. Stick to your investment plan and avoid chasing the market. 4. Set a margin of safety. Always look for stocks that are undervalued relative to their intrinsic value. This way, even if the market drops, you're protected from significant losses. Remember these important points. Investing is about buying stocks for long-term value, while speculating is about betting on short-term price movements. Speculation is risky because it's based on unpredictable market movements and ignores the fundamentals of the company. Avoid emotional decisions by focusing on the intrinsic value of a company and making long-term investments. The margin of safety is a key principle for investors. Buy stocks below their intrinsic value to protect yourself from market drops. To avoid speculation, focus on fundamentals, think long term, and stay disciplined. In this chapter, Graham makes it clear that speculation is a dangerous game, especially for the average investor. Instead of trying to time the market or chase quick profits, focus on buying solid companies with strong fundamentals and make long-term investments. By following this disciplined approach, you'll avoid the pitfalls of speculation and set yourself up for steady, sustainable growth over time. Stick to value investing. It's the best way to build wealth responsibly. The Future of American Business, Chapter 14. In Chapter 14 of The Intelligent Investor, Benjamin Graham shifts focus to an important question. What does the future hold for American business? This chapter is all about looking at the long-term prospects of American businesses and how investors should think about the future when making investment decisions. So, let's break it down and explore Graham's thoughts on how to prepare for the future. Optimism about America's growth. Graham starts by sharing his optimistic view about the future of American business. He believes that American companies have a solid track record of growth and innovation. The U.S. economy has consistently bounced back from challenges, whether it's recessions, wars, or financial crises. Despite ups and downs, the country's businesses have shown resilience and adaptability. However, Graham also emphasizes that investors shouldn't take this for granted. While America's future growth potential is strong, it doesn't mean every business will automatically succeed. Investors still need to carefully evaluate individual companies and industries before putting their money in. Technological progress and innovation. A major theme in this chapter is the role of technological progress in shaping the future of American business. Over the years, new technologies have transformed industries and created new opportunities for companies to grow. From manufacturing innovations to advancements in information technology, these changes have allowed businesses to operate more efficiently and create new products and services. Graham suggests that investors should consider the impact of technology when assessing the future prospects of a business. Companies that are adaptable and willing to embrace technological advancements will likely be better positioned for long-term growth. However, he also warns that not all technological innovations will succeed. So it's important to carefully analyze the potential of emerging technologies before investing in companies that rely heavily on them. The impact of globalization. Another key point Graham discusses is globalization and its effect on American businesses. As the world becomes more interconnected, businesses now have access to global markets, which opens up new opportunities for growth. However, globalization also brings new competition from companies around the world, which can create challenges for U.S. businesses. For investors, this means that it's important to look at how a company is positioned in the global marketplace. Some businesses are well suited to thrive in a global economy, while others may face significant risks from foreign competitors or geopolitical issues. Understanding how global trends affect industries and companies will be crucial for making informed investment decisions. The role of government and regulation. Graham also touches on the role of government policy and regulation in shaping the future of American business. Government decisions, such as changes in tax laws, regulations, and trade policies, can have a significant impact on the profitability of businesses. Therefore, investors need to stay informed about potential changes in the political and regulatory environment. However, Graham advises that investors shouldn't try to predict short-term policy changes or bet on specific political outcomes. Instead, he encourages a more neutral approach, understanding that businesses can adapt to different regulatory environments and focusing on the long-term stability of companies. The importance of diversification. One of the major takeaways from this chapter is the importance of diversification. Graham stresses that no matter how promising a business or industry might look, there will always be uncertainty about the future. That's why diversifying your investments across different sectors, industries, and even regions is crucial for managing risk. By diversifying your portfolio, you reduce the impact of any single company's poor performance on your overall investment strategy. It's important to spread your investments across a range of assets to safeguard against unforeseen risks, such as economic downturns or changes in industry dynamics. The risk of speculating on the future. Graham cautions against the temptation to speculate about the future. Some investors may get excited about new trends or emerging industries and buy stocks based on the belief that these sectors will outperform. However, Graham points out that speculating on the future is highly risky. It's easy to get caught up in the excitement of new technologies or market trends, but the future is always uncertain. Instead of speculating, Graham recommends sticking to value investing, focusing on companies that are already solidly established with strong fundamentals. Rather than trying to predict the next big thing, it's smarter to look for companies that are well positioned to succeed in the long run, regardless of short-term trends. Remember these important points. America's business future looks bright overall, but investors need to carefully assess individual companies. Technological progress is key to long-term growth, but not every tech trend will succeed. Globalization provides growth opportunities, but also creates risks due to increased competition. Government policies and regulations play a significant role in business success, but investors should focus on long-term stability rather than short-term political changes. Diversification is crucial for managing risks and ensuring a balanced investment portfolio. Speculation on the future is risky. Investing in businesses with strong fundamentals is a more reliable approach. In this chapter, Graham reminds us that while the future of American business is promising, success isn't guaranteed. Investors need to focus on long-term stability, understand the global landscape, and adapt to technological advancements. Rather than trying to predict the future or jump on every new trend, stay grounded in value investing principles. By doing so, you can position yourself for success in the evolving world of business. That's it for Chapter 14. Keep these principles in mind as you navigate the future of investing. And remember, it's not about predicting what will happen. It's about being prepared for whatever comes your way. The Stock Market in the Long Run, Chapter 15. Hey there. In Chapter 15 of The Intelligent Investor, Benjamin Graham takes a closer look at the stock market's behavior over the long term. Now, when we think of the stock market, we often imagine short-term fluctuations, prices going up and down day after day. But in this chapter, Graham zooms out and focuses on the long-term trends that every investor should keep in mind when planning their investment strategy. Let's dive into the key points from this chapter and see what Graham has to say about how the stock market behaves over the long haul. The stock market as a long-term investment. Graham starts by explaining that the stock market, over time, tends to move in a positive direction, meaning that it generally increases in value in the long run. However, he makes it clear that this doesn't mean it's a smooth ride. The market will experience ups and downs, sometimes sharply, and you'll have to deal with these fluctuations as an investor. What's important here is that long-term investors can benefit from the market's overall upward trend. If you're in the market for the long term, say 10, 20, or even 30 years, there's a good chance your investments will grow, despite the short-term volatility. Market fluctuations and investor behavior. One of the key points Graham makes is that investors need to be prepared for market fluctuations. The market is unpredictable in the short term, with prices often going down based on factors like economic conditions, political events, or even investor sentiment. However, Graham advises investors to focus less on these short-term movements and more on long-term trends. For long-term investors, these fluctuations can be a blessing in disguise. Instead of worrying about short-term losses, you should see them as opportunities to buy stocks at lower prices during market downturns. If you hold on to strong, fundamentally sound investments, you'll likely see positive returns over time. The impact of compounding. Another important point Graham discusses is the concept of compounding. When you invest in stocks, your returns from those investments, whether through capital gains or dividends, can be reinvested to generate even more returns. This process, known as compounding, can lead to significant growth over the long term. The beauty of compounding is that it works best over long periods. The longer you invest, the more your initial investment grows exponentially as your returns compound. This is why patience and long-term thinking are so important in investing. Graham encourages investors to think of the stock market as a way to build wealth gradually over time, rather than looking for quick wins. Risk versus reward in the long run. Graham also touches on the relationship between risk and reward. While the stock market can be volatile in the short term, over the long term, the reward tends to outweigh the risk. The key is to stay disciplined and stick to your investment strategy. Even during times of market uncertainty, if you stay invested in companies with strong fundamentals, your long-term outlook remains positive. Remember, the stock market rewards those who are patient and disciplined in their approach. Trying to time the market or make frequent trades based on short-term trends is a recipe for disaster. Graham advises investors to take a long-term perspective and not let short-term market movements shake their confidence. The importance of a balanced portfolio. One way to mitigate risk and ensure steady returns in the long run is by maintaining a balanced portfolio. Graham stresses the importance of diversification, having a mix of different types of investments, stocks, bonds, etc., to reduce your overall risk. A diversified portfolio can help you ride out market downturns and still benefit from long-term growth. For example, while stocks may provide higher returns, they can also be riskier in the short term. Bonds, on the other hand, might offer more stability but lower returns. By balancing these assets in your portfolio, you're ensuring that you're not overly exposed to one type of investment. Avoiding speculation. Graham also warns against speculating in the stock market. Speculation is when you buy stocks based on the belief that their price will rise quickly, without considering the company's fundamentals. While speculation might work out for some people in the short term, it's a risky approach that's more about luck than skill. Instead, Graham advises investors to focus on value investing, buying stocks in companies that are undervalued based on their long-term potential. This approach is more likely to provide consistent returns over the long run and helps you avoid the pitfalls of speculative trading. Remember these important points. The stock market generally increases in value over the long term, despite short-term volatility. Long-term investors should focus on holding solid investments and avoid reacting to short-term fluctuations. Compounding plays a huge role in growing your investments over time. Patience is key. Risk and reward are linked, but the long-term rewards of investing in stocks usually outweigh short-term risks. Diversification is essential for managing risk and maintaining a balanced portfolio. Speculation can be tempting, but it's a risky game. Value investing is a safer and more reliable long-term strategy. In Chapter 15, Graham encourages investors to look beyond the day-to-day movements of the market and focus on the bigger picture. The stock market is a long-term game, and if you're patient, disciplined, and invested in solid companies with strong fundamentals, you'll likely see positive returns. So, instead of worrying about short-term price fluctuations, keep your eyes on the long-term horizon and let the market work for you. The Intelligent Investor in Practice? Hey everyone! In Chapter 16 of The Intelligent Investor, Benjamin Graham wraps up his investment philosophy by putting it all into practice. This chapter focuses on how you, as an investor, can actually apply the principles and strategies Graham has outlined throughout the book to make smarter, more informed investment decisions. If you've been following along, you'll already know that Graham is all about value investing. But now, let's see how we can bring those ideas to life in the real world. The key idea: investing with a plan. Graham emphasizes that successful investing requires a clear plan and strategy. It's not just about picking stocks randomly or jumping on the latest trend. Instead, the intelligent investor must focus on a methodical approach to investing based on the fundamentals of the companies they're considering. That means looking at company valuations, understanding their earnings potential, and figuring out if the stock is undervalued or overhyped. Graham urges you to stick to your strategy and avoid getting swayed by market noise or emotions. The market might be up one day and down the next, but your focus should always be on long-term value and growth. The role of investor psychology. Now, one of the biggest challenges in investing is psychology. As humans, we're wired to make decisions based on emotions like fear and greed, especially when it comes to money. Graham discusses how the emotional side of investing often leads to mistakes. When stocks are soaring, you might be tempted to jump in without doing the proper research. And when markets crash, fear might make you sell off good investments just to avoid losses. To overcome this, Graham recommends practicing self-discipline. You need to stay calm during both market highs and lows. A key part of the intelligent investor's mindset is being able to separate emotions from decision-making. Instead of reacting to short-term changes, take a step back and ask yourself, does this align with my long-term strategy? The defensive investor versus the enterprising investor. Graham identifies two types of investors: defensive investors and enterprising investors. A defensive investor is someone who wants to minimize risk and doesn't have the time or desire to put in too much effort when it comes to investing. For them, broadly diversified, low-cost index funds or well-established blue-chip stocks are usually the best options. The defensive investor focuses on safety rather than high returns, and their goal is steady growth with as little risk as possible. On the other hand, an enterprising investor is someone who's willing to put more time and energy into researching and finding undervalued stocks or other opportunities. These investors are more hands-on and willing to take on more risk for the potential of higher returns. Enterprising investors often have a keen interest in picking individual stocks and monitoring market trends more closely. Graham advises that before you begin investing, you should first ask yourself which type of investor you are. Knowing this will help you build a portfolio that aligns with your risk tolerance, time commitment, and goals. The importance of diversification. Another key point Graham makes is the importance of diversification. Whether you're a defensive or enterprising investor, diversifying your investments is crucial to reducing risk. If you put all your money into one stock or sector, your portfolio is highly vulnerable to volatility in that area. Graham suggests spreading your investments across different asset classes, stocks, bonds, and even international investments. By doing this, you protect yourself against potential losses in any one area of the market. While diversification won't completely eliminate risk, it certainly helps reduce it and makes your investment strategy more robust in the long run. The margin of safety. Now, you might have heard of the concept of the margin of safety. This is a key principle in value investing. Graham encourages investors to only buy stocks that are undervalued, meaning they're trading for less than their intrinsic value. By doing so, you create a cushion or margin of safety that helps protect you from downside risk. In practice, this means buying stocks at a discount. If you can buy a stock for less than it's worth, you're essentially protecting yourself from potential losses as the stock has room to grow. However, it's important to remember that this strategy requires patience. It might take time for the stock to reach its true value, but over the long term, it often pays off. Staying informed and educated. Graham also stresses the importance of staying educated and informed as an investor. Whether it's reading financial reports, keeping up with market news, or studying a company's financial statements, the more you know, the better equipped you are to make informed decisions. However, Graham warns against overanalyzing or getting caught up in the noise of daily market movements. Instead, focus on long-term fundamentals and big-picture trends. Remember these important points. Successful investing requires a clear plan, either defensive, low risk, or enterprising, higher risk but higher potential rewards. Investor psychology is crucial. Avoid emotional decisions and stick to your long-term strategy. Know which type of investor you are, defensive or enterprising, and tailor your strategy accordingly. Diversification is key to reducing risk in your portfolio. Invest with a margin of safety. Buy undervalued stocks to protect yourself from losses. Stay informed and educated, but avoid getting distracted by short-term market fluctuations. In Chapter 16, Graham shows us how to put his investing philosophy into action. Whether you're a defensive or enterprising investor, the most important thing is to have a solid plan, stay disciplined, and focus on the long term. By focusing on the fundamentals of a company, diversifying your investments, and using strategies like the margin of safety, you can position yourself for financial success. So, the next time you're thinking about your investment strategy, remember the principles from this chapter and apply them to make informed decisions. Invest smart, and you'll be on your way to becoming an intelligent investor yourself. And that's a wrap on today's deep dive into the intelligent investor. I hope you found these insights helpful and that you're feeling more confident about applying these strategies to your own investing journey. If you enjoyed this video, don't forget to hit that like button and subscribe for more content like this. And if you have any thoughts, questions, or want to share your own investment strategies, drop a comment below. I'd love to hear from you. Keep learning, keep growing, and as always, invest smart. See you in the next video.